30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, U.S. diesel tops $5 a gallon as the Iran war continues to squeeze energy supplies.
Meanwhile, Delta delivers an upbeat outlook showing the airline's resilience in the face of higher fuel costs.
And Nvidia gets a muted market reaction to Jen-Hsun Huang's $1 trillion forecast.
Well, I have that muted market reaction, which, by the way, on average, when he speaks, the stock doesn't move a lot. So I don't know what we were expecting.
Right, and as Ed Ludlow points out, this is the Super Bowl for them.
Yes.
So they say a lot of big, crazy things that are actually stuff, it turns out, we already kind of knew about.
Yeah, and that's kind of priced into the stock. So that's what we're seeing. We're only up 0.6%, 0.7% in the pre-market. They unveiled a suite of partnerships, plans to build chips for everything from robots to data centers and space. They are targeting $1 trillion in sales through 2027. Also announcing a partnership with both Uber and Lyft to give them autonomous vehicle technology. Those shares are moving
right on. And I saw a video of Olaf on stage with Jen-Hsun Huang.
Super important.
As well. So we'll talk about their connection to Frozen. A cross-asset check on S&P futures right now higher, even as we see Brent crude futures rise. So that relationship breaking down this morning. Brent up to $102 a barrel. NYMEX is up as well. You can see the 10-year yield continues to come down. That's also an interesting relationship that we haven't seen so far. Typically, when oil futures are up, you see stock futures down and the 10-year yield higher on inflation concerns. But today, I guess, Dani, it's not the case.
It is not the case with continued action in the front of war. Israel claiming it killed another top Iranian official as the war shows no signs of abating. Iran ramped up attacks on energy assets around the Persian Gulf, setting a massive UAE gas field ablaze. President Trump spoke yesterday as questions grow over how long the conflict can last.
Can we wrap this war up this week?
Yeah, sure. Good.
Will we?
I don't think so, but it'll be soon. Won't be long. And we're going to have a much safer world when it's wrapped up. It'll be wrapped up soon. We're going to have a much safer world.
Diesel prices, as Matt pointed out, have now jumped to $5 a gallon in the U.S. That's the first time since December 2022. The Iran conflict is tightening supplies and ripples throughout the economy. Joining us now is Bloomberg's EMEA News Director, Will Kennedy. Will, we are seeing not just the price of oil, but some of these other products move higher. How sustainable does some of the tightness in this market look with the most recent attacks?
That's exactly right, Dani. We are seeing the impacts throughout the fuel market, and that's because refineries can't get as much crude oil as they used to. That's putting pressure on product supplies. That's having people bid up the price of these products like diesel. And diesel is central to the way the economy operates. That means trucking, but it also importantly means farming. People's tractors and harvesters, they all use diesel. So it's a real input into the economy, which will, if it's sustained over a period of weeks and months, add real inflationary impetus. We should also be looking at jet fuel. We're seeing the price there, and that will feed through into plane tickets. We had the Delta CEO this morning saying that its fuel bill had jumped by tens of millions of dollars this month. So we are starting to see those impacts, and it's transferring through these oil product markets.
Will, I continue to see headlines like the one out of the UAE this morning that they've suspended loading these tankers in Fujairah. Why would they be loading them anyway? Are any ships getting through the strait? I thought that had been closed for the last, 2.5 weeks. So why would we still see people loading tankers?
Well, the significance of Fujairah, Matt, and the reason that the Iranians are targeting it, because it is the one Emirati port, the one port in the UAE that lies outside the Strait of Hormuz. You're right to say that most tankers aren't loading inside the Persian Gulf because there's no ships to put them on and they can't get out. Those ships are full already, but outside they can. There's 1 million barrels plus that goes through a pipeline from the Gulf side of the UAE to the Indian Ocean. So that's why it's vital to this effort to try and get as much oil out as possible and why the Iranians are hitting it. The other part of this story is the Red Sea. The Saudis are ramping up 5 million barrels a day of exports on this east-west pipeline they have across the Arabian Peninsula that allows them to export from the Red Sea. And that effort, again, is really important to keeping as much oil moving as possible. Those tankers haven't been hit by Iran, perhaps because they can't, perhaps because they think it's a step too far. But that's another thing for markets to watch and we'll be very alive to.
Well, there are some tankers that are moving through the Strait of Hormuz. The team's most recent reporting, a Pakistani tanker, 2 India-flagged liquefied petroleum gas tankers were also able to exit the strait. Does it seem like there is movement, but it's just on Tehran's terms? And does that move the needle at all for energy markets?
We don't know exactly on what terms those tankers move through the straits, but there have been a few very limited movements, not nearly enough to make a material difference to the disruption that we're seeing in energy markets, but it is important nonetheless. And when we look at the route of those tankers, it does suggest that because of the way they cleave close to the Iranian coastline, that it probably is, as you say, happening on Iran's terms. And we know that some countries have reached out to the Iranian government and asked for safe passage for those ships, including India and Pakistan. And so it's an indication that might be happening. And it's just really an illustration of how much power Iran has in this situation, that it is able perhaps to dictate terms as to who can go through the straits and who can't.
All right, Will, thanks very much. Will Kennedy runs our global oil coverage for us here at Bloomberg. Let's get to the airlines now, a big buyer of those crude products. Delta Airlines issued a more optimistic sales target for the first quarter after bookings accelerated to start the year. The CEO, Ed Bastian, says fuel costs have jumped by $400 million so far this month. Let's get details on what all that means with Bloomberg Aviation editor Benedict Campbell in Washington, D.C. So, Benny, what do we know from Delta and their upbeat forecast?
So we have a whole raft of executives presenting today. Here in D.C., there's a big J.P. Morgan conference, and Delta came out first out of the gate with a very upbeat outlook. And I'll be honest, I think a lot of people are coming into this day thinking there might be more measured comments, there might be more a muted outlook, but in fact, everyone's pretty upbeat. You mentioned Delta, but then American Airlines also came out and said, we've seen some of the strongest bookings yet in our history, frankly, in March alone. So people are really rushing to lock in these prices. The question is, how sustainable is that? If the fuel price, the fuel price for kerosene remains high, what does that mean for longer-term ticket prices? And that's maybe what you're seeing right now, that customers are rushing to buy the tickets, which is why you're seeing the strong demand. But as longer that this conflict keeps going, that might become unsustainable.
What tends to be the relationship between jet fuel prices, especially for the likes of Delta, Benny, which does have its own refinery? When can we expect higher ticket prices, and can we expect consumers to stomach that?
We've already seen some airlines add so-called fuel surcharges, and that's really across the world. You go from New Zealand to India to Europe, so companies are already locking in higher prices, and that feeds right through to the ticket price. In the US, we've not seen it yet, and there is still a group of consumers, a rather large group, that are willing to spend. We heard from Ed Bastian, the Delta CEO, this morning saying there is a sizable group of customers that still want to travel, that have made this a priority for their spending habits, and there's really no let-up here. Where it might start hurting is more on the sort of economy-minded end of the spectrum, so people who book cheap tickets, who are cost-sensitive, and the airlines that cater to these kinds of people. So the JetBlues of this world, the Spirits of this world, that's where you might see more of a fallout. So really, if you come into this crisis, and it is a crisis for the industry the longer it keeps going, and you're coming into it strong, with a strong balance sheet, and in the case of Delta, you have your own refinery, so you have something of a protection, then you're going to come out of this stronger. But for the others, we're looking at potentially tough months.
Benny, great to have you in our time zone. That's Bloomberg's Benedict Campbell, who's in D.C. for an industry conference, so perfect timing to have you here. Now to AI, Nvidia's Jen-Hsun Huang announcing a number of partnerships at the GPU Technology Conference. He also laid out plans for data centers in space, of course, and reaffirmed his $500 billion annual sales target.
Right here where I stand, I see through 2027 at least $1 trillion. $1 trillion is an enormous amount of infrastructure. That infrastructure investment you could make on Nvidia, you could make with complete confidence. We have now proven that.
Let's get the latest from Bloomberg Tech co-host Ed Ludlow. Only a matter of time before Jen-Hsun started talking about data centers in space. Ed, what new did we learn from the conference yesterday?
Yeah, I think a lot of people are still trying to understand the $1 trillion figure, right? The interpretation from the sell side, at least, is that it's extended visibility on demand, on sales opportunities. So the range is 2025 through to the end of calendar 2027. It's $1 trillion, but they were not explicit that it is just Blackwell and Rubin systems. The prior outlook of $500 billion that you mentioned, which was stated on October 28th in DC, was just Blackwell and Rubin and also included networking. It emerged after the fact. The main thing that Jen-Hsun Huang emphasized and underlined is that they expect to be short. He said, we will be short. In other words, that the demand is still going to outstrip their ability to supply. And a part of the kind of more muted pre-market reaction you just showed on the screen relative to the big jump when the headline hit yesterday is that the $1 trillion still tracks pretty close to consensus anyway. It's more a validation of estimates rather than anything revised.
But I mean, Jen-Hsun Huang is nothing if not a hype man. And Ed, he talks a lot about the importance of Nvidia in each layer of the AI layer cake. Explain that analogy to us.
Yeah, the 5-layer cake. In other words, at one extreme you have the results of AI agents, the output that an AI agent can give, and at the other end of the extreme, the infrastructure, the data centers which are powered by their GPUs. And a big part of this story has been Jen-Hsun Huang trying to convince the market that if broadly, not just the hyperscalers, but software companies as well, invest in the infrastructure, that compute equates to tokens, the generation of tokens, and for those companies, more broadly, tokens will result in revenue growth. And that was very much sort of weaved throughout his on-stage 2.5-hour delivery yesterday.
And yet the stock has been flat for like 6 months. Why can't he move the needle here?
Well, again, just interpreting the sell side's read on the $1 trillion outlook, we call it an outlook. It's not necessarily firm sales guidance. It's visibility on the demand they see for AI compute and AI infrastructure. But it tracks very close to consensus. It's not a huge, it doesn't represent a huge acceleration or additional upside to what the street was already modeling for anyway. And that is a part of the stock. Although, the stock now a percentage point higher in pre-market. Maybe people have had more time to read. All right.
Ed Ludlow, we're going to give those people another hour and a half before you come on the program. Ed Ludlow hosts Bloomberg Tech. They kick off at 11. Let's take a look at some of the other movers on our radar right now. Qualcomm approved a $20 billion stock buyback and boosted its dividend. As a result, those shares are up 3% in the pre-market.
Elsewhere, Oklo just got approved by the Energy Department to build its first nuclear reactor in Idaho. Shares up 7%.
And Victory Capital submitted an improved proposal for Janus Henderson that values the firm at $56.84 a share, $56.84. I could put that another way.
They both work.
It exceeds Trian's bid for Janus by $1.2 billion.
Their bid has always been higher than Trian's bid, but Janus is, for whatever reason, doesn't even want to engage with them. That's been the story here.
Right. Well, because I think Trian has a history with the company.
Yeah.
So.
They do, and for whatever reason, Victory.
It's not all about the money, Dani.
It's a big part of it, though. It's a big part.
Coming up, more pain ahead for private credit. Morgan Stanley says defaults could reach 8%, which seems like a relatively low number, considering.
Higher than what it's been.
Yeah, but aren't
been
we?
like 1 to 2.
UBS said 15.
Yeah, true. They did say 15.
We'll talk about this when we come back. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. President Trump says he asked China to delay his summit with Xi Jinping for about 1 month, citing the need to oversee the war in Iran. In the Oval Office yesterday, he also spoke about Cuba.
I'll be having the honor of Taking Cuba. That'd be good. That's a big honor.
Taking Cuba.
Taking Cuba in some form, yeah. Taking Cuba. I mean, whether I free it, take it, I think I could do anything I want with it.
Meanwhile, car maker Audi expects new SUV models and cost-saving measures to boost the brand's profitability this year. I spoke with the CEO, Gernot Doellner, about the turnaround plans.
I have a very broad strategy covering all you just mentioned. On the one side, we have a cost reduction plan to reduce our fixed costs. We had in 2025 an agreement with the Works Council to reduce the indirect personnel till the end of 2027 by 7,500 people. But even more important is that we are working on modern structures.
Morgan Stanley sees private credit default rates climbing to 8% as advances in AI continue to disrupt the software industry. In the note, strategists say elevated leverage and looming maturity walls within the software sector may push default rates near peak levels unseen since the pandemic. Dani?
For more on private credit concerns, Bloomberg credit reporter Emily Grafeo joins us now. Emily, you took a look at this research and you've been reporting on this sector for some time now. How much of this is just a return to normal, a credit cycle that's been really benign versus deep issues within software for private credit?
Well, so the strategists at Morgan Stanley do say that they only see most of the defaults in the software sector. But the reason why people are kind of on edge right now is because software makes up so much of the private credit industry. Alternative asset managers were funding this sector for basically the last decade because they thought there were reliable revenue streams. Now, with AI and the disruption that could cause, it's come into question. 8% would be about where we were during the pandemic. Financial crisis, it was about 10%. So 8% is higher than where we are right now.
We survived that after the pandemic.
Yes, we survived it after the pandemic. And they do point out that the credit cycle is in the late stages.
You know, first of all, yesterday there was a Wall Street Journal story about John Zito from Apollo who said, like, he would be cutting all marks right now. It was clarified that he meant in software. He says there will be an issue with respect to credit, which I think will be worse than people expect. And secondly, UBS has said default rates could be 15%. And Bruce Richards from Marathon said not only does he expect 15% default rates, but that could happen in multiple years, in 27 and 28. So this doesn't seem that bad.
Yeah, so 15% though for UBS, that was their worst case scenario. The reason why this Morgan Stanley note stood out to my colleague Renee Ismail and I is because this was Morgan Stanley's base case. If you look at it though, again, they do say risks in the private credit market, significant but not systemic. They pointed to the fact that outside of the software sector, corporate balance sheets still remain healthy, like you were pointing out, Dani. And so they don't see risks spreading beyond just software. So I guess survivable?
That's all well and good, but the thing that I keep coming back to is now that this is a product not just for institutions, but retail too, and it was sold to a lot of retail clients, is this thing is uncorrelated with the rest of this market. It's a safer asset. It's semi-liquid, so you can get your money out, but it just factors in the rest. I mean, you're talking about this. This is the rest of the credit cycle. They are exposed to it, whether it's public or private credit. I mean, it feels like the worst time to be pushing these products onto retail right now.
Right. There's a bit of a self-reinforcing cycle. Once there's fears around credit, then people start to want to get their money out. And that's exactly what we're seeing right now in the retail funds, the business development companies, investors trying to redeem their shares. And some of these funds saying, we can't give you all of your money back all at the same time.
That is the gates are a feature, not a bug, Matt.
Yeah, that's what I thought. But apparently no one told these retail investors that.
Apparently not. Hey, Emily, thank you so much for joining us this morning. That is our Bloomberg credit reporter, Emily Grafeo. Coming up, Jack Janasiewicz says that there are limited catalysts to support U.S. economic growth. He joins to discuss oil, earnings, and much more. Stay with us for that conversation right here on Bloomberg Open Interest.
If we had known that you were going to more than double from the December low in oil to where we got to a week and change ago, and we saw the string of payroll reports that we've seen over the last 6 months, would you have really thought that stocks would only have been down 5%, essentially in a 6-month range? we would have thought the number would be down 15, 20, or 25%. It speaks to the resilience of the market.
Julian Emanuel with Evercore this morning. Let's add another excellent voice to the conversation. Natixis lead portfolio strategist Jack Janasiewicz joins us now. Jack, thanks for coming in this morning. Do you share Julian's amusement, surprise, call it what you will, that stocks are only down about 5%, despite the fact we're grappling with $100 plus oil and war and supply chain disruption in the Middle East?
Yeah, it is a little bit surprising that the market has held up as well as it has, especially when you look at the forward curves, and that's something that's a little bit concerning for us. When you look at that oil price going out, 12 months from now, it continues to creep higher. Volatility sort of doing the same thing. To me, that's just the market repricing in the higher for longer scenario, and that's probably not a good thing, especially for the consumer, as it acts as a consumption tax going forward here in the United States.
So why is the market so sanguine? It doesn't seem like it's really moving the needle too much. I know we've been down a bit,
right?
Or flat to down is really what it feels like.
My guess would be either one, we still believe in sort of the taco trade. That sort of seems like it might be running out of fumes here, and at some point we might have to rethink that idea. The other one could simply be that from a relative value perspective, U.S. is a little bit more insulated, so to speak, and we've already had a pretty significant derating in there, so the cushion is actually built in that's a little bit more pro-U.S. So maybe from a relative value perspective, the defensive areas of the market, so to speak, tech in this case, lends it a little bit more favorable to the U.S., and it's maybe from a relative perspective why it's hanging in better than everybody else around the world, so to speak. All
right, well, we do see futures higher, Jack. We're going to keep you with us through the opening bell. We will bring you the ringing of the New York Stock Exchange and NASDAQ market site opening bells in just a couple of minutes. We'll show you what happens when we go from futures to the cash trade. But the market looks pretty strong right now, up 0.5% on S&P futures, even with Brent crude up 2% to $102 a barrel. This is Bloomberg. Moments away from the start of trading, and futures are higher. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at 0.5% gain on S&P futures. The same is true for the NASDAQ and the Russell 2000. This even as we see oil rising again today. I guess it's only $102 a barrel for Brent and not even $100 a barrel for WTI. So maybe that's some cold comfort. This is really cool. TC Energy, TRC is it TRP? TRP, ringing the bell at the New York Stock Exchange. I was just looking at their stock, and it's doubled over the last 5 years, but it's absolutely soaring this year. It's up another 17%. They do energy infrastructure, moving around sort of things like liquefied natural gas, and people want that, obviously, right now. Also very cool is that Merlin Labs is ringing the bell at the New York Stock Exchange, and Matt George, who you see, at the NASDAQ market site, Matt George, who you see here, will be on our program in just about 1 hour's time. They develop autonomous technology for planes, and that's not just like autopilot, like the blow-up doll in an airplane, but actually for like fighter jet kind of planes. So very advanced.
And just wanted to make clear, it was the adult at the center. The CEO isn't a small toddler.
Yes, not the kid. Not the kid.
That'd be very surprising. Some of the stocks I'm watching this morning, Nvidia, only moving up 0.25%. They unveiled a suite of partnerships. They plan to build chips for everything from robots to data centers and space. The company targeting $1 trillion in sales through 2027. They saw an initial move higher after that, but Matt, how much of it is already priced in? So not a whole lot of action this morning.
Yeah, $1 trillion is a great number to throw around, but if you do the math and figure out that was already in the plans, it's not as exciting. IBM, speaking of, it was among the firms that partnered with Nvidia to improve AI data sets. It also just closed an $11 billion deal to acquire data streaming platform Confluent. This is another thing that we already knew about, but all the admin has been done. We're going to sit down with the CEO, though, of IBM in just a few minutes' time. Arvind Krishna will join the program. Right now, let's get back to Natixis lead portfolio strategist Jack Janasiewicz. And Jack, I wonder where you see mispricing here, where you see values that maybe the rest of the market has overlooked. Have we thrown anything out, any babies out with the bathwater, so to speak?
Yeah, and I think a lot of that comes back to really the tech space, because right now, to us, it's really acting more of the defensive sector, right? You've had a pretty substantial derating, so the valuations have come down. I still look at the things that I think after COVID, investors were looking for in those defensive names. You know, big margins, still healthy cash flow, no debt on the balance sheet, buying back stock, going through that whole list. You know, those things are still, I think, superior relative to the rest of the market. So maybe we've discounted tech to a point where maybe that's something to rotate back into from a defensive perspective. That way you're still at least invested in the market. So if we do get the taco trade in effect, the market pops, you still have upside, but at the same time, you get a little bit of a cushion if this longer, higher for longer for oil continues to play itself out and pulls the, economy slower.
Even though tech's doing better, there still is this feeling of the market if there's nowhere to hide, because maybe the AI concerns are still very real for them. And with that, Bank of America, their latest fund manager survey showed cash levels jumping from 3.4% to 4.3% in March. That's the biggest increase since the pandemic. Is cash a better place to be hiding out right now? Do you want to be hiding out on the sidelines?
Yeah, it's tough right now from a portfolio perspective, because the concern obviously with the bond market could be that if it starts to price in the inflationary impulse, you'll start to see bond yields rise. So you're not going to be able to hide out there. Gold really hasn't been doing much in this recent sell-off. Maybe you get a little bit of the Bitcoin diversification here, but I think in general, some of the things that we would tend to look for from a diversification perspective for a defensive positioning in the portfolio isn't really helping. And so I think cash is one way to think about it, but I think maybe it's just a general rotation within the portfolio to maybe take a little bit out of the cyclical sector, move more back to the growth side of the equation. And that includes maybe moving from small caps to large caps, moving away from international back to U.S., maybe tilting a little bit in emerging markets to China and to Latin America, those sort of things. I think that's maybe the better way to play it right now.
When we talk about the potential for President Trump, for the U.S. to find an off-ramp and take it quickly, how do you feel like markets would react if you heard President Trump say, you know what, we've won? I mean, he said that many times, and we're out.
Right. I think you get a relief rally. But the bigger issue is, where do oil prices, where do energy prices go from there? Because at the end of the day, I think what this shows is that Iran still has full control over the Straits of Hormuz. That's never going to change. Does the political calculus now suddenly shift? Because Iran has basically shown that they can take the global economy hostage, and they're doing it through the use of oil in this case. So that perspective really doesn't change. So does that put a little bit of a premium back into the energy space? And as a result, maybe prices don't necessarily return to $60 where we were prior to this, and we have a little bit of a step function higher in the energy backdrop, and I think the market still needs to come to terms with that portion of it.
What difference does that make for risk assets? If we're not at $100 a barrel, but maybe it settles at 70 or somewhere around there, that's higher, but not as high as it's been during this conflict.
It'll probably be a little bit of a chop. We need to digest things, rethink things, but then once we sort of get our feet underneath us, we'll get back to what really matters here in earnings, and then we'll see what the flow through is to earnings as a result of these higher prices going forward.
Jack, are you worried at all about private credit? Because there's been a lot of talk of the distraction this war has caused, and yet every day we have some kind of private credit headlines.
Yeah, based on what we've been seeing, and a lot of this still sort of resides in the BDC space, which is largely a retail product at this point. We still think it's somewhat idiosyncratic. When we start to look at the banks that are lending to the BDCs who are then making the loans, you're basically looking at the idiosyncratic risk. How does that move to a systemic risk? You're probably not seeing that transmission mechanism move right to the banks. And when you start to look at the loans that banks are making, I think it's something close to $300 billion in total. If you look at some of these, it's 1 to 10% of that total loan portfolio that's being dealt out to the BDCs. If you assume a 10% default rate, you're looking at 1% of the total loan book potentially going bust. So from an idiosyncratic risk, I think that's where it stays. Is it a systemic risk? Just to see it translate into the banking system, I have a hard time seeing that. And the last thing I would say there is, I think everybody has this 2008 itis, right? That's going to, I think, help to sort of mitigate things, but it's also, I think, a concern that might be a little bit overblown. The stuff that happened in the global financial crisis, we've taken a lot of steps to prevent that from happening again, and that's also, I think, going to short-circuit this sort of potential nasty cycle working its way from an idiosyncratic risk to a systemic risk.
But if there is an issue in private credit and defaults pick up, should we have the expectation for wider credit markets then? We have seen spreads start to widen after being at historically tights. Are we headed for an actual credit cycle?
Yeah, and this will be, I think, interesting because you're conflating, I think, the potential for a slowing growth backdrop with some of these idiosyncratic risks.
So I think when you get the recovery here in asset prices, what I'll be watching for is what are spreads doing? Do we see spreads actually then start to rally as a result of that? If we don't, that tells me there's something more at stake here with regard to this potential pass-through, if you will.
You know, before these two issues, right, war and private credit, we were so focused on AI. Is it a bubble? You know, they can't spend enough. Now they're spending too much. Where's the money? Like ROI. How does it look right now?
You know, listen, you got to look at these CapEx spends from the hyperscalers. They're coming out and saying, you know, second place is for losers, basically, right? We still need to be the winner.
They're still saying that. They're still spending as much as they possibly can.
So the bottom line here is they're still going to spend. And someone's going to be a beneficiary of the spend. So you may not like the specific spend from that, from that specific stock name, but someone's going to benefit from that. So,
by the way, we're funding it no problem, Jack. Every time they come to market with a bond issue, even if it's $50 billion, it sails through.
I mean, these guys look like, AA single or AAA credits from a perspective of balance sheet. So, again, you may not like the CapEx spend for that specific name, but the broader impact to the market is still someone's earnings. And I think that's the bigger takeaway from our perspective here.
Jack, this has been so fantastic to have you on. Thank you so much for joining. That's Natixis lead portfolio strategist, Jack Janasiewicz. Let's get your check on equity markets right now, just about 10 minutes into your trading day. And as I told Matt before, I didn't wear green today because the market's doing it for me. So happy St. Patrick's Day to you. The market's up 0.6% this morning, being led by the big cap tech, Amazon, Nvidia, Meta, faring the best in terms of points added to the S&P 500. Uber's pretty high up here, too. They announced a new partnership with Nvidia for autonomous vehicle technology. The bank's having a really good day, too. They've been somewhat beat up over the past 2 weeks. Looking to the downside, some of the healthcare companies are down. Eli Lilly down 2%. I do want to point out Corning. Okay, so this is a company that makes fiber optic cables. And Jen-Hsun Huang in the, whatever you call it, the Nvidia conference that they had, the GPU GTC, of course, rolls right off the tongue. He said that they're still using copper cables. And this is a company that makes fiber optic cables, and one of the big bets is that Nvidia's and the other data centers of the world would start using their products, but maybe that's not the case, and they're going to just be using copper. So that's the story with that. All sectors, though, are higher this morning, unless things have changed in the past minute. No, they have not. All sectors are higher, as I point out. Healthcare, one of the laggards. That's followed by energy, with oil prices still above $100 a barrel. But it is that rebound in financials that leads the overall market higher, up 1.5%, with the S&P up just under 0.7%, Matt.
All right, so fascinating. I mean, the fact that everything is up, even as oil rises, is interesting. I guess it just
for sure
isn't rising as high as we had feared. Coming up, IBM's CEO joins the show to discuss their new partnership with Nvidia, as well as the $11 billion takeover of Confluent. This is Bloomberg Open Interest.
A check on equity markets this morning. We are moving higher, if I have them. I promise you we are moving higher. There you go, 0.7%. The NASDAQ also just about at that level. Russell 2000 index also up 1% as bond yields come in, even though the price of oil is higher. Still getting a relief rally. Let's look at some of the top calls this morning, the analyst action that we are following. First up, HSBC downgrades Eli Lilly to reduce, saying that expectations for the total addressable obesity market are due for a correction. That's an interesting one because it is a really big total addressable market. Shares are down 1.6%. Next up, Mizuho raises its price target on Exxon to $162, expecting the sector to benefit from higher oil prices as the war in Iran continues. Shares only up 0.33%. Finally, Argus downgrading DraftKings to hold. They cite aggressive competition from prediction markets. Matt, those shares up just over 1.5%.
All right, so IBM has closed its acquisition of data streaming platform Confluent. That was an $11 billion purchase. Bloomberg Tech's Caroline Hyde joins us now to discuss that, as well as NVIDIA's announced partnership with the CEO of IBM.
Arvind Krishna joins us. It is a joy to have you on our network, Arvind. And look, speed is the name of the game. This deal has completed swiftly, and indeed Confluent is all about speed and data analysis. How is that important in this age of AI?
Yeah, so Caroline, it's great to be here with you and on Bloomberg. So just look at what Confluent does. Moving data in real time so that it gets available both for the enterprise, for analytics, but more importantly for AI agents. And doing that in a way that is the most capable product in the world is why it is so exciting to get it done. And your point on speed, I think the regulatory environment is definitely friendlier, where we got this done in just under 4 months, whereas it used to take a lot longer a few years back.
If regulatory environment is friendlier, should you be doing more of it? Should there be more M&A, particularly with some beaten up overall valuations of software companies at the moment?
I'll just say watch the space.
Oh, watch the space. Okay, but where would you want to add on in this moment, Arvind? What would make sense to be adding to your portfolio?
So we're very focused. Hybrid cloud and AI and the intersection. So if you look at Confluent, some of the data is in cloud, some of the data is in SaaS properties, some of the data is on-premise. An AI agent needs to get hold of it wherever. So that's the hybrid piece combined with the AI piece. Our sweet spot is going to be hybrid cloud, AI, automation, are the areas where we are very, very focused on M&A activities, as well as organic development. If you look at what we have done around our What's the Next products, what we have done around mainframe modernization, these are all things that we have built organically, but then we supplement it with targeted acquisitions where the multiple makes sense, where it fits our strategy, and where we can normally increase the growth rate of the target property, which we certainly hope to do in the Confluent case.
Let's talk about What's Next a little bit. Let's look more at partnerships, because of course that's what was announced, a little bit more of a deeper partnership with Nvidia yesterday, helped your stock. We're seeing expanded collaboration. Again, this is about faster data analysis, but cheaper, more effective. How does that help you seal more deals?
Yeah. So in that one, actually, the work we're doing together with Nvidia was a 5 times speed up. So 5 times, not 5%, not a little amount, but 5 times. So there we began to leverage the NVIDIA GPUs together with some of their CUDF software, combining it with our What's the Next data. And the example we used was our client Nestle, where together we managed to get that speed up across their massive amounts of data. And that really is important. In that case, combining some of the technologies we work on also in open source with the Presto data engine, NVIDIA, and the example at Nestle, but then we're very excited. We're going to do more work on that and then take it into the market and take it out to hundreds of clients from there.
You're offering these tools, but you're also helping companies like Nestle just embed AI, make sure they're using it in the most effective manner possible. When your consultants go in, how much does a Nestle want to use your offerings, but those of Anthropic, of OpenAI, of others? How much do you see that as a competitive force or a competitive threat?
Look, our goal has always been that we want to help our clients integrate the best capabilities from where they come. And the word integration comes in here because to some extent we are model agnostic. We believe that our clients are going to use the frontier models from all 3 or 4 of the main providers. They're going to use open source models, and they're also going to use models from us, though we tend to make much smaller models. But helping them really get value, and I really believe 2026 is the year when enterprises are going to be focused and obsessive on ROI or what they're doing on AI. And so if you take Nestle, how do you take cost out of procurement? How do you take cost out of HR, the finance function, procurement, all of these things? And that's where our consultants and our technologies come together to help them do that, using both technologies from IBM, but also in the case of Nestle, from many other of the partners and the software vendors that they use.
So do you think the investor base and just more broadly your customers as well see that AI isn't a double-edged sword for you, but actually that competitive threat that sunk the shares so much on February the 23rd was a misunderstanding of what Anthropic could do with COBOL?
I'm going to be much more straightforward. I believe that the investors and parts of the media misunderstood what that blog said and did. I actually am convinced AI is the tailwind for us. It's not a mixed half headwind, half tailwind. AI is a tailwind for us in terms of how our technology will get adopted, in terms of what we do with our clients. And by the way, we had put out tools to convert and modernize COBOL 2.5 years ago. So there was no new news in that blog, but they certainly can get a lot of attention.
You talk, though, what also gets attention is being able to become more productive, take costs out of the business using AI. A lot of people see that as the costs of people. We're seeing Block remove 40% of their employee base. You hear about headline after headline. Is that what's going to happen to the labor force, Arvind?
So I'll take ourselves. We've been very public that we have taken $4.5 billion out of the enterprise with a mixture of AI and automation. That's a hard number. Now, over $3 billion of that got reinvested into the business in more R&D, in more sales, in more marketing, in more delivery, in more what we would call client engineering, where clients love the fact that our engineers can work with them to help them solve problems. So there is a reshaping of the workforce, but there isn't a net decrease. And to put our money where our mouth is, we will do 2 to 3 times as much entry level, meaning college hires this year, as we did last year.
Wow, so you're still seeing that demand for that level of technical prowess coming straight out of university, Arvind. But I'm interested, you have said in the past, look, you see job displacement, your term and phrase, of 5 to 10%. Is that done now at IBM, do you think?
I think that we're probably halfway down that total journey, and I still stick to my total numbers in that range. And I think we're halfway through that journey, but our total employment has remained roughly stable. So to the point that I make about there will be more opportunities, but you've got to be willing to upskill yourself and retrain yourself.
What's not stable is the geopolitical environment, Arvind. How is that affecting you? How is that affecting the consulting part of the business in particular?
Look, let's acknowledge there's a lot of pain and disruption that's going on in the Middle East right now. I think we should feel a lot of sympathy for our people. We have thousands of employees in that region. The vast majority, I think, are reasonably stable and are getting their work done. There are about 20% of the people in the Middle East who are disrupted, who are not able to get to their clients, who are not able to get the work done. I think within a quarter is going to be very, very minor because most of this work is much more long cycle than short cycle, as in days or weeks. If this goes on for many more months, then I do think that we will take a slight headwind. But in the end of the day, our consulting business in the Middle East is only a few single-digit percentages of our total business. So it won't impact IBM's top line and bottom line, but it is going to be impactful to some of our people and some of our clients who are in the region.
Thanks for that nuance, Arvind. And I'm interested just on the nuance of total sales growth in consulting. Will that come back to growth, do you think, in the near term?
I think when I was talking in January and also in October, I felt that the second half of this year will be a lot better on consulting growth than right now. We kind of said that we could see an inflection coming where the first half of last year was negative. The second half of the year turned kind of flattish. I think that we'll see continued improvement in that inflection to maybe slight growth in the first part of the year. But true growth, I think, is still out in the second half of the year.
True growth, true excitement about quantum always seems to be in the second half of the decade or the millennium. But you really are putting your money where your mouth is when it comes to quantum computing becoming, really tangibly useful by the end of the decade. You want to have a fault-tolerant quantum supercomputer by 2029. How on track are we there? How on track are we to integrating quantum within the data center?
So on all three of your questions, Caroline, I think we are completely on track with what we had said. We said that we're going to have better qubits, better quantum processors, and our processor at the end of last year is now being used, whether it's for medical work at Cleveland Clinic, whether it's for bond pricing at HSBC. Those are real use cases that are coming out. We expect to see error correction between this year and next year demonstrated and out there. So that'll be another big plus. We're investing very heavily in how we bring together normal computers and quantum computers. We put out a roadmap for quantum-centric supercomputing that has gotten a lot of attention. Our partnerships with academia, with institutions. I'm so excited by what we're doing in Illinois, but also at RPI, with MIT, and in other places. We have done some work with the national labs. Yeah. This is all tells us how tangible it is, and you can feel it. People are now realizing this is not science fiction. This is not engineering to get through the next 2 to 3 years.
I think I can feel your energy today. Congratulations on the completion of the Confluent deal. And we are staying tuned for any more M&A. Come back on when it happens. IBM CEO Arvind Krishna, great speaking with you. Dani.
Caroline, thank you so much for bringing us that conversation. Bloomberg's Caroline Hyde, and thank you again to IBM CEO Arvind Krishna. Now, breaking moments ago, we want to bring you this X post from the head of U.S. counterterrorism, Joe Kent. According to his social media account, he has decided to step down. It's worth reading some of this, Matt, because it's quite striking, saying, quote, "I've decided to resign from my position as director of the National Counterterrorism Center effective today. I cannot in good conscience support the ongoing war in Iran. Iran posed no immediate threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby." He goes on to say that it was an echo chamber that deceived the president into believing that Iran posed an immediate threat to the United States. Should just point out that Joe Kent had himself been appointed to this position by the president.
Yeah, he was, I can see by his CV, a Green Beret. He'd been deployed 11 times, and his wife, Shannon, was killed in a bombing in Syria in 2019. And that is, according to the Washington Post, what pushed him into politics. He ran for Congress twice and lost, but was strongly aligned with President Trump, and so he was appointed to this position.
This is, I believe, the first case of someone in the administration resigning over the war in Iran, again saying that the president has been deceived. What difference does this make in the president's push to try to find an off-ramp in this conflict?
All right, we're going to continue to follow this breaking news for you. Coming up in the next hour, Marta Norton on the U.S. market looking suddenly resilient compared to the rest of the world. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Markets on the front foot this morning, despite the fact that oil prices are higher, but still a risk rally underway.
Yeah, oil prices feeding through to gas prices, and diesel topping now $5 a gallon at the pump as the Iran war continues to squeeze energy supplies.
As the war rages on, we'll discuss the future of defensive tech with Merlin CEO Matt George and Blackwater founder Erik Prince on his new IPO.
And Jensen Huang's unveiling a suite of new products helped to give the stock a little boost. He also pitched a $1 trillion AI future, which we'll talk about. But first, let's get into stocks extending gains into a second straight day. Julian Emanuel of Evercore spoke on surveillance this morning.
If we had known that you were going to more than double from the December low in oil to where we got to a week and change ago, and we saw the string of payroll reports that we've seen over the last 6 months, would you have really thought that stocks would only have been down 5%, essentially in a 6-month range? We would have thought the number would be down 15, 20, or 25%. It speaks to the resilience of the market.
Joining us now is Marta Norton, Chief Investment Strategist at Empower. And Marta, Julian is not alone here. I mean, we heard sort of indirectly through the Wall Street Journal that John Zito also was telling his wife last month, before the war in Iran, that he thought the market would be down 10% and we were flat. What do you make of this resilience? Where is it coming from?
Well, I think there's a few different factors that we're watching. I think first, when we're thinking about the conflict, the war in Iran, it seems as though the working assumption in markets, regardless of kind of what asset class you're looking at, is that while this might be longer than most of us would like to see, it's not an actual long-term disruption, and we will see some sort of normalization. I think when we're thinking about scenarios, maybe you're looking at a few weeks, maybe a month or more of disruption, but not something that stretches into the 6-month type of time frame. And I think that's undergirding markets broadly. I also think when we're looking at the fundamentals of companies, the earnings that they're delivering, the resilience of the consumer, I think a lot of that is speaking to an economy that isn't rolling over. And I think that's also supporting markets.
It's supporting markets, Marta, but at what point, if we do get a situation where just oil needs to reset higher, we were talking about this with Jack Janasiewicz in the last hour, this idea that now we know Iran has the capabilities to control the Strait of Hormuz. Even if the conflict ends tomorrow, even if it opens up, this threat will forever be hanging over energy markets. If that means we need to set the price of oil higher fundamentally, what does that do to risk assets, even if it's not $100 a barrel, but just a bit higher?
Well, here's what I find so interesting about some of the research around oil shocks, or to your point, oil prices that level set at kind of a resting heart rate that's above the mid-60s that we saw a month or so prior. When we look at what the Federal Reserve, for example, Bank of Dallas has seen, when they look at oil price shocks and how that flows through to the economy, it's not necessarily the deal breaker that a lot of us anticipate. So certainly you see headline inflation move higher, and you certainly see a follow-on effect in core inflation. But if we're looking at the war in Ukraine, for example, and the price shock that we saw then, it wasn't actually a huge driver of core inflation, and it didn't necessarily knock the legs out of GDP either. It has an effect, but maybe not as profound as we fear. And so I think some of that should give us a bit of confidence. We can't, ignore the fact that there could be a much worse scenario coming, but at least in the time being, it does give us some confidence that even if prices level set higher, we're not looking at disaster-like scenarios.
Even before these inflation fears, or I should say, simply before the war in Iran, we were all worried about the future of software, at least some portions of the software universe, and we'd shifted from AI bubble fears to AI, disruption fears. How do you look at that sector now, especially since we've seen the Mag 7 fall into correction territory, that index down 10%?
Well, I think when we're looking at a technological build like AI, we have to prepare ourselves for moments of doubt. This is a huge amount of money. It's a long time frame, and there's going to be points in time where we're really going to question the capital allocation, the wisdom, where the revenue is, all of those things. So I think, a moment of doubt in and of itself is not necessarily indicative that the thesis isn't intact. So I think what we really want to pay attention to is where are valuations? What are they telling us in terms of how investors are pricing in different potential outcomes? And actually, as I look at members of the Mag 7 today, as I look at the software trade, and I think of these valuations that have come down so meaningfully, I feel as though we're pricing in a broader range of outcomes. And that gives us a little bit more confidence to edge into some of these areas that, last September were actually really overpriced. So in some ways, if you have a long-term time frame, if you're investing for a 5-year frame of reference, I don't think these are bad opportunities today, selectively.
Marta, does that mean that you would not be following the majority of the fund manager survey participants in the latest Bank of America survey, where they jumped in terms of cash levels to 4.3%? It was 3.4%, and that's the biggest increase since the pandemic. Does cash have a usefulness in a portfolio where it seems is dealing with a different existential threat every day?
Yeah, well, I think when you're looking at cash rates and exposure there and the increase there certainly is always going to be kind of a momentum factor that's driving how people are positioned. But I also think there's some utility to cash. I think it creates that dry powder so that you can move into these opportunities when they come off. I also think if we're expecting maybe rates to be more range bound than maybe folks had anticipated when the Fed was talking about resuming its cuts last fall, I think there's some rationale, some kind of reasonableness to having a cash stake. I think you can play both sides of this. I think you can have elements of your portfolio that are conservatively positioned, but I don't think you should be afraid to move against the grain and move into some of these areas that are also selling off.
Marta, thanks very much for joining us. Marta Norton there of Empower. We appreciate your intel today. Now, National Counterterrorism Center Director Joe Kent, we told you before the break, has resigned over the war in Iran. In a post on X, he said, quote, "I cannot in good conscience support the ongoing war in Iran. Iran posed no imminent threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby." Bloomberg Washington correspondent Tyler Kendall joins us now from the White House. And Tyler, this has been a concern of some in the MAGA sphere that the president is no longer sticking to the principles that governed his first term.
Right, Matt. I mean, I think you really hit the nail on the head there. This does underscore what many in the America First camp have been saying when it comes to what they had hoped would be a President Trump that stayed out of foreign entanglements. And you really hit that top line from his post where he is resigning in protest, saying that he can't in good conscience back the Trump administration's war in Iran. Now, head of the National Counterterrorism Center, Kent was in charge of the agency tasked with analyzing and detecting detecting terrorist threats. But as you well know, this administration has been contending with questions about the objectives of the war and what it ultimately took for the Trump administration to launch the operation, as White House officials have repeatedly said that their goals include dismantling Iran's ballistic missile system, making sure that Iran abandons its nuclear ambitions and ends its support for proxy terror groups. We're learning more about this as it evolves, but this does, of course, mark the first high-profile departure since the war with Iran began. Matt and Dani, Kent was confirmed narrowly last year by the Senate. He is a two-time congressional candidate, didn't win either of his races in Washington state. He was confirmed with a Republican majority, 52 to 44.
I wonder, there was an Atlantic piece about J.D. Vance, who also was very opposed previously to U.S. excursions, as President Trump calls them, in the Middle East. I wonder if we'll hear more of the president's administration in terms of protest against this intervention.
I wouldn't be so sure at this point. We've really seen most officials stick by President Trump. In fact, just yesterday, we saw Vice President J.D. Vance and President Trump appear alongside each other for the first time since this conflict began. And the vice president was pushed about his support for the conflict. And he said that at this point, he has his full trust in the commander in chief. But you're exactly right to bring up that point, because I remember when then Senator J.D. Vance was in the Senate and he used all of his power to block, for example, additional supplemental aid to Ukraine under this idea that the U.S. really does need to focus first at home and build up our own weapon stockpiles. Revitalizing the defense industrial base was something that J.D. Vance actually campaigned heavily on, and the idea of bringing more of that manufacturing to his home state of Ohio. So it's going to be something to watch. But at this point, Matt, we haven't really seen those fissures emerge. This really does mark the first one.
Tyler, thank you very much for your reporting this morning. Bloomberg Washington correspondent Tyler Kendall live at the White House. A quick check on equity markets this morning, about 40 minutes into your trading day, and we are moving higher despite oil at $101.95, moving up by nearly 2%. U.S. stocks are higher, and I'm looking at these alternative asset managers. Apollo's higher by 5.3%. So is Blue Owl, as is KKR, Ares. So a good day for them in financials as a whole. They are all rebounding this morning. Make of it what you will, Matt.
All right, we'll talk about it when we come back. Private credit concerns escalate a bit today as Morgan Stanley says its base case for defaults is 8%. We'll speak with Robin Doumar, founder of Park Square Capital, next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. JP Morgan is planning to add hundreds of jobs in Boston after agreeing to become the anchor tenant in the city's newest skyscraper. The bank said in a statement that it expects to hire about 300 employees across departments over the next several years as it consolidates its offices in the South Station Tower. Leaders at Soc Gen and Deutsche Bank are reassuring investors on the quality of their exposure to private credit. At a conference hosted by Morgan Stanley today, Soc Gen CEO said the level of repricing of collateral is non-significant, while Deutsche Bank CEO Christian Saving said the German lender hasn't lost any money on private credit exposures. Meanwhile, over at Morgan Stanley, strategists see private credit default rates climbing to 8% in their base case as advances in AI continue to disrupt the software industry. In the note, they say elevated leverage and looming maturity walls within the software sector may push default rates near peak levels unseen since the pandemic. Dani?
Well, I'm so happy to say that we're going to get more into this conversation. Joining us now is a veteran of the industry, Robin Doumar, founder of Park Square Capital. Robin, thanks so much for joining us when you're stopping by in New York. We always appreciate it.
Thank you, Dani. No, this is great. Great to be with you.
I mean, and what a time. Okay, so you have this from Morgan Stanley saying 8% default rates. UBS said that the bear case could be 15% default rates in private credit. What are you actually seeing on the ground? Is there stress right now?
I think what's interesting, if we just look at the facts, right now the leverage loan market, which is probably the best liquid indicator of value, has traded off maybe 2 points since the beginning of the year, from something like 97 to something like 95. Now, within that, what's responsible for most of that drawdown is software, which is probably off closer to 10 points. So those are liquid marks. They're not signaling a 15 or 8% default rate. They're signaling a bit higher default rates. And we would expect that. It's late in a cycle. We would expect that normally. And then you have the AI overlay. What we're seeing, I think, within software now, even within those liquid marks in the loan market, is a increased differentiation where the high quality companies initially traded down, and now as people do their credit work, they're saying, wow, some of these businesses are extremely defensive, very difficult to tear out of an organization's enterprise, and risky to change. They may have embedded transactions in them. They may have a regulatory overlay. That's really tough stuff to change. Those companies are rising to the top. And things that are more speculative, remember we used to talk a bit about ARR financing and non-cash flow financing. That stuff looks really vulnerable. So I think it's a differentiation is the theme.
Even if some of them, though, are resistant to change, I feel like clients maybe have a little bit more pricing power now. John Zito in the Wall Street Journal story that I'm sure you saw a couple of days ago said he thinks all of the marks are wrong. I think it was clarified that he meant in software. Do you have software exposure, and what do you think about the marks?
So we do have software exposure. We are very selective, and we've been credit pickers for 21 years. I'm now 38 years in the business, and for the first time, I would say my neighbors want to talk to me about private credit, which should tell you something.
I thought you were going to say you're 38 years old.
Yeah, thank you. And look, what I would say is I think there will be vulnerabilities. In our business, what we've seen through the global financial crisis is the key, I think, to our business in managing risk is avoiding zeros. And I think investors lose sight of the fact that in senior lending, you can get zero. If you're lending to a business which is existentially threatened, you can face a complete wipeout. And I don't think people have processed that in. So the key is credit picking. I think another theme of John's comments that I think is very notable is the cultural difference between closed-ended fund managers in private equity and people who are managing these semi-liquid vehicles. A closed-end fund can be very patient in the way it deals with holding investments, restructuring investments, following its money. These open-ended vehicles, it's a real test. We're going through a test for the market. They offer real advantages to investors, but they come with some risks, which is, do the investors understand the liquidity? And we saw over the last several years enormous retail inflows into private credit. We talked about the golden age of private credit. Well, I think it was the golden age of retail fundraising for private credit. And now I would tell you, I think now for closed-ended drawdown funds, now is the golden age, which is the ability to step into dislocation and acquire assets at great discounts. And what you're saying, Matt, and I think it's right, a much more lender-friendly environment.
Just how discounted has it been? Because we've heard from the Blue Owls of the world, others saying, yes, we've been selling our assets to meet redemptions in our BDCs, but we've been selling close to par. Is that true, or are there some real value assets to be had right now?
I think across entire portfolios, that's probably about true. And I think the trades took place at near par. There's normal settlement mechanics in these secondary trades, which may be a bit more of a benefit for the buyers. But broadly, I think that's accurate. There are more portfolios coming. Clearly, if you are doing a responsible job of managing these liquid vehicles, you're trying to make sure that you are dealing with your investors. They're not entitled to get their money back. I mean, I'm sure that the risk factors of these things, when investors read them, are not pleasing them, because I think the managers have the ability to just literally stop any redemption. But this is an investor relations challenge. This is not a structural risk for the economy and all that. It's an investor relations challenge.
That's an important point to make, because I think a lot of retail investors are worried that it could be.
I don't think so. I think they may have to wait a little bit longer to get their money back.
No, I mean the fact that it's not a structural risk for the rest of the economy.
Yeah, it is not.
Because there are so many comparisons with 2008, and people are coming on this show and saying, that doesn't make any sense, because this is not that big. It's not mortgages.
It's not that big. The total loan market, entire complex is $3 to $4 trillion. I mean, that's less than the market cap of some big companies. So this is noise in the overall scheme of things, I would say.
Do you think, though, for a lot of these companies, they've pegged their next leg of growth on retail? That retail wealth is what's going to allow them to grow, especially for the big public managers. I guess part of the issue is the education, to your point, that you often have brokers or wealth advisors who are second order giving these products to people. Did we do, royal we, a good enough job of describing to everyday mom and pop investors exactly what these products are?
I'm not sure. But it's going to be tested now. And I think what's interesting is you're seeing a divide. I think institutional investors do not want to be associated with these funds increasingly. I think they see themselves as being long, traditional closed-end fund investors. And I think we're seeing growing concern with institutional investors in the liquid products because you get involved with the retail investors. And it's clear that the flow of capital now is exiting the market.
By the way, at some point, does the flow of capital turn from just a structural headline issue into a fundamental one? Are there second-order impacts of needing to redeem as you get outflows from more retail-oriented funds?
100%. And I think actually that is the really interesting question, which is, okay, this is all great. Yes, there's some redemption pressure. What's the second and third order effects? And I think they are a number of these retail-oriented structures will be frozen. They are not going to be making new investments. They're going to be prioritizing returning capital. What happens in a restructuring? Can you follow your money? Can you draw? Because that's how we protect ourselves ultimately in a restructuring, is to write everything down, follow our money, start over. Can these complexes do that? I think it's going to be more challenging to do that. And so I see a growing divide between the closed-end fund complexes backed by institutional capital and these more semi-liquid backed by more retail-oriented capital. And it's a great time to invest now. I mean, we are very excited. We have typically in direct lending stayed out of the U.S. for the last several years. The market was very retail-oriented and frankly commoditized. That's changing. It's getting more interesting now, and we're very excited about, frankly, the direct lending opportunity from today forward. I'd also point out that closed-ended funds, when you start a new closed-ended fund, you don't have to deploy the capital right away. You can deploy it over 4 years, 5 years, and each vintage cleans itself. It heals itself. Okay, we had a bad vintage. People may have done too much software. You know, the private equity complex and closed-ended funds start again with a clean sheet of paper. That's not true for these evergreen vehicles. And so we'll see how, without liquidity, they can heal themselves over time. It's a really interesting test and challenge.
And could be an advantage for the players with cash to spend. Robin, great to have you on the program. Hope we can get you back soon. Robin Doumar there of Park Square Capital. I want to turn back to autos. Audi expects new SUV models and cost savings measures to boost profitability this year. I spoke with the CEO, Gernot Doellner, about his turnaround plans.
At the core is a balanced portfolio from entry car to the pinnacle on the top of your portfolio. But of course, you need some hero cars to really show what the brand is capable of. And the RS5 is one of these cars, and it's our first performance hybrid, and will definitely help to transform Audi to the future. In addition to all we do on the design side with the Concept C and the mentioned E5 Sportback in China, so it's a variety of measures that will drive the brand.
How important is it, by the way, given the volatility of the tariff picture and all the headwinds that you mentioned, to try and get a substantial production footprint in the U.S.? And I'm thinking specifically of Scout in South Carolina. There have been reports you could build a new, bigger truck there. Is that something that you're thinking about for this year?
Yeah, it's two things. On the one hand, is really to have a market-specific portfolio with combustion engine cars, plug-in hybrids, and battery electric cars. And for the US, definitely combustion engine cars in the right segments. And we are bringing the Q7 and the Q9 this year to the US. And the Q9, first time we have this full-size SUV, a car that is has been developed to the requirements of the US-American market and will be launched in the US this year. And as you mentioned, in parallel, we are thinking about come up with a production footprint in North America using facilities that are there from Volkswagen Group or even build an Audi plant in the US.
All right, that was the CEO of Audi, Gernot, Doellner, and I have had one of their products.
As have I.
You have had one of their products. And I think for a while, Audi seemed to go quiet. But this year, they have come roaring back because they're in Formula One.
Yeah.
They scored points in their first race. And they've got a new RS5 out that is just knocking the socks off of critics. You can hear more about it on my podcast. It's called Hot Pursuit with Hannah Elliott, and it airs every Friday. I mean, it's a podcast, so it doesn't air, but it drops.
Go listen to it any day you want.
Coming up, the latest from Merlin and Swarmer CEOs on how autonomous tech is reshaping defense. This is Bloomberg. Aviation startup Merlin is hitting Wall Street. The company building the operating system for autonomous flight, aiming to enable fully self-flying aircraft across military and civilian use. Joining us now is Matt George, co-founder and CEO of Merlin Labs. He rang the bell this morning at NASDAQ market site with your 3-year-old son, which is like bucket list.
So fun.
He's already checked that off. All right, talk to us about, first off, what the product that you guys engineer and put out there, because I was joking about the Airplane movie, Blow Up Doll with Dani this morning. I don't think she's seen Airplane, but this is much more sophisticated than autopilot on like a 747.
We're bringing AI and combining it with traditional avionics systems to enable aircraft to go fly themselves. So either with reduced crew or totally on their own, we're taking that next step up from traditional autopilot to fully autonomous aircraft.
And from takeoff to landing, and it can make decisions in the air.
Correct. Takeoff to landing. We fly it all the time out of our facility in Quonset, Rhode Island. Talks to air traffic control, does a bunch of other cool stuff, both for civil and, most importantly right now, defense use cases.
How big of a step up is that from the technology that currently exists? Because it's my understanding that flights, as they stand, are mostly being operated by the technology inside of the plane, and the pilots themselves don't do as much as they historically do.
That's a great question. We joke that we're kind of born on third base versus some of the autonomous car companies because we have 60 years of history of how autopilots work. So we're just taking that next step and applying some AI to actually go from where autopilots are today and where they've been honestly for 60 years and bring them to the next step for our civil and military customers.
And it's all the more important right now, or at least the importance is highlighted by the war in Iran.
Yeah.
Right? We've already seen a few planes shot down. Fortunately, I think those pilots were able to bail safely, but I guess the hope is that we'll be able to do this kind of operation in the future when it's necessary without endangering the lives of our soldiers.
One of the things we're most proud of at Merlin is building that autonomous platform of record for whatever the future of American air power looks like. As we've seen in Iran over the past couple weeks, that's really dangerous, and we did lose a tanker crew. We had 6 crew members who were lost in a KC-135 tanker in an air-to-air collision. So anything that we can do to bring autonomy to make those service members safer and more effective is really at the core of what we're doing and why we went public today, to rally some more resources to get those things in the hands of those people.
By the way, what about for commercial aviation? Because we've had some crashes over the past few years that we think may have been intentional, on the part of the pilot. That could be avoided with your systems.
Most airplane accidents come down to human error. I'm a pilot. The closest times I've come to doing something really dangerous in an airplane is not because the airplane broke or not because of some external factor, it's because of a mistake that I made. And I think every pilot will tell you a story like that. So if we can bring autonomy to those aircraft, we can reduce those aircraft accidents and make aviation much safer, but also much more accessible for folks around the world.
Do you think, that's a clear and very strong message, I think, for a populace that is constantly worried about headlines of aircraft accidents. Do you think, though, that the appetite and the comfort level is there to have a fully autonomous flight for civilian use?
It's got to be a staged approach, and that's why we're really proud of the fact that we're not going right to sort of that Jetsons end state. We're taking the autonomy, putting it in large aircraft to assist humans, and then gradually that autonomy gets more and more capable to make aviation safer. But it's a stepwise approach to get there.
So you rang the bell this morning. You're coming to Wall Street, I guess, through a SPAC. What kind of capital are you getting, and how will you deploy that capital?
Yeah, so we made the decision to go public, to go rally hundreds of millions of dollars behind this problem, particularly at this moment in time, particularly for some of our defense customers. As you've seen in the news, American air power is changing, and we need to go keep up with the rest of the world. So we're going public today in order to go rally hundreds of millions and eventually billions of dollars behind that problem. And then also do things like M&A to make sure that we're bringing people into a big tent and making sure that we're making autonomous aircraft for a really important American mission.
What's the moat you have with the technology itself? What's to stop one of the big airlines themselves from trying to develop their own in-house AI systems?
Yeah, so we compete with some of the biggest aerospace companies in the world, like Lockheed Martin and a few others. We have one mission in life, which is to make safe and very, very effective autonomy versus some of the other big defense primes who are doing everything. So we're spending hundreds of millions of dollars on the problem. We are far out in front of those others who are working on the problem. And we're building a deep moat built around certification, but most importantly, built around actually getting it in the hands of users and getting that experience, which is something that's very difficult to catch up with.
You know, it seems trivial right now, but the last time I spoke with you, we were in the middle of the longest government shutdown in the history of the U.S. And I recall defense contractors having issues with that getting paid, right? How do you deal with a government shutdown? How do you deal with that kind of volatility?
Ultimately, our mission is to make sure that the service members who are on the other side of the government get what they need. So throughout those shutdowns, we deployed our own private capital to make sure that we weren't missing any of those milestones. We didn't miss any of those milestones, and we kept going on our own dime to make sure that we get those warfighters what they needed out in the field.
How are you viewing just the relationship with the government right now? A very different AI company, but an AI company nonetheless. Anthropic had a skirmish with the Department of Defense because they didn't agree with how they wanted to use their technology. How do you approach these matters when there are issues of privacy and data use, especially when it comes to AI systems in the hands of the government?
It's got to be a close collaboration with the Department of War and private industry, but ultimately, at the end of the day, our mission, regardless of who's in an administration, is to provide those tools to the service members who need them the most. We're really proud of the fact that we're doing that, but we do have to have that conversation with the Department of War and make sure that it's a two-way conversation. But ultimately, we're following the democratically elected government, and we're entrusting the tools that we're building into their hands to go serve the folks that need it the most.
All right, Matt, thanks so much for joining us on Open Interest. Matt George there, the co-founder and CEO of Merlin. Now, from autonomous flight to the next frontier in defense, Swarmer is going public. It makes software that enables drones to operate together as a coordinated force. It has supported over 100,000 real-world missions, and joining us now to talk about it is Erik Prince, the non-executive chairman of Swarmer. He is, of course, the founder of Blackwater, and we'll get to that, Erik. But I want to first ask about this technology, because it's not the actual drones that you make, but it's a technology that enables them all to act as one force together, right?
That's right. Swarmer makes a brain which allows drones to act cooperatively together, effectively an AI pilot, because Ukraine, out of desperation, needs to fly hundreds of thousands of drones. They did not have hundreds of thousands of pilots. Swarmer acts as that automated pilot, doing up to 25 drones under control in combat at the same time, a mesh network that allows the drones to cooperate. Of course, humans set the parameters and the targeting, and the drones figure it out. It is the way of the future. Clearly, as you see, the 70% of the casualties in the Ukraine war are caused by drones. Warfare has changed, and the cost of delivering energy, if you think about two things a military commander does, coordinates information and releases energy. The cost of releasing energy, of putting warheads on foreheads for the West, is grotesquely too high. I'm extremely excited to be part of Swarmer because it is proven technology. Like you said, they've done 100,000 missions in combat. This is a company that's been at war for 2 years, not doing testing in America, not doing test labs. It's actually tested in combat every day. And so we're going public to build out our technology even further, to apply not just in bomber drones and FPVs, but maritime interceptors, of course, and to also provide a platform for a lot of other very capable, proven combat technology from Ukraine, because the West is behind. When you have a $30,000 drone targeting U.S. infrastructure in the Middle East, and we have to shoot a $2 million interceptor or two $2 million interceptors, add that to knock it down, we have a problem in the West. And so lowering the cost of delivering precision weaponry is essential, and Swarmer is going to be a big part of that.
Erik, that's been a huge topic of conversation in Iran. Exactly what you're saying. The fact that they are using cheap drones and our technology to bring them down is much more expensive. You and the team at Swarmer clearly is working hard and fast to deliver this type of technology. But how do we ensure that a war in Iran doesn't continue along this path, that we don't keep spending exorbitant amounts of money and trying to fight a technology that it seems Iran just has so much of and has so much of cheaply?
I'm not here to litigate the decision-making that got us into this. All I will say is now that we're in it, I'm all vested for the United States military to win, but they have an exceedingly difficult task.
All right, so exceedingly difficult task that you're trying to make easier with Swarmer. Let's talk about the proceeds from the IPO and what you're going to invest them in. Where does this capital go?
Sure. Of course, more engineers to go from bomber drones and FPVs to, of course, maritime interceptor capability, because Swarmer is a brain. It's a capability that allows drones to cooperate and behave and to attack targets autonomously. You can imagine the demand signal blinking red across the world to be able to intercept all these cheap drones and to meet threat with a cost-effective threat. Not the ridiculous $2 million solution that the U.S. defense cartel comes up with, but rather very cost-effective solutions so that we, A, can be effective, and B, not bankrupt as a country.
So, Erik, it is clear that the center of gravity in warfare is changing. As you continue along this path and you act as the non-executive chairman of Swarmer, how do you see the battlefield looking in 5-10 years? Just how big of seismic shifts are we about to witness?
It's like going from crossbows or longbows to machine guns, not just even rifles. That's how much of a change. Warfare will even change society because of the democratization of precision strike. When, just imagine the difference. An old Javelin missile, which cost $150,000 a shot, with a $200,000 launcher, now you can do the same job with a $750 drone out to 15 kilometers. It's an extraordinary change, and the Department of War, the U.S. defense budget has gotten way too bloated and way too dependent on a cartel that is not very competitive. The true innovation, the battle lab, has been Ukraine for the last 3-4 years, and we ignore that at our peril.
What lessons should we take from Ukraine, or Iran for that matter, Erik, in order to save money on defense? I mean, it's not something you want to scrimp on, obviously, but I think the administration right now has floated another $500 billion raise for the total budget to $1.5 trillion.
The Department of War is at least doing some programs like the Drone Dominance Program, where they've cast wide a net for new competitors to come into the space and offer to say, hey, can you fly a drone? Can you hit a target? Can you do that? That's at the FPV level. That's kind of an infantry level weapon system. They need to do that across the spectrum to bust up the ridiculous cartel that is the Northrop, Lockheed, Raytheon guys that are literally going to bankrupt the country.
Just to that point, Erik, what competitive advantage does Swarmer have versus one of those defensive primes? What's to stop a Lockheed Martin or Northrop Grumman, for example, from trying to build something similar?
Well, they can try to do that, but the difference in Ukraine, you can go from idea to concept to prototype to combat proven in a matter of weeks or a month or two. You can't do that in the United States. The leading edge of battle in Ukraine, because the Russians are very adaptive, very capable in electronic warfare and jamming and counter drone systems. So your idea, your prototype, is going to work very quickly, or it's going to get smoked, and you know that very quickly. The U.S. has a very lethargic design, build, testing program with a highly bureaucratic system that really it prevents the kind of speed of iteration that you get with Ukraine, with people are operating out of their garages.
Erik, I want to get your take on the either benefits or drawbacks of autonomous weaponry. This debate was highlighted, obviously, by the Anthropic negotiations with the Department of Defense. But how do you see autonomous weaponry? Is it something that we need in our military, or is it something that we should fear?
Adapt or die. That genie is out of the bottle. Look at what the Iranians are doing with very low-cost weapons destroying most of the key radar systems, having pushed U.S. aircraft back another 1,000 miles from the edge of battle because they're at risk. Those are with cheap, basically self-driving, right? The Shahed missile is basically navigating itself based on ground interaction, on terrain contour matching. You can call that even a version of AI. They're doing that, and they're doing that for $30,000 a piece versus multi-billion-dollar radar systems and weapon systems. It is a true asymmetry that we truly will ignore at our peril.
Erik, I think just, for everyday people, when they hear about this technology, the fear is always, what if it gets used at home? Not necessarily drones, but AI surveillance type technology. Again, as Matt mentioned, that was part of the Anthropic disputes. You could always say, I trust this current administration, but what happens if there are other administrations that I don't trust? How do we balance out a genie that's out of the bottle, advanced tech that's become necessary for the battlefields versus concerns at homes and issues of privacy and otherwise for an American public?
I think people do not realize the extent of surveillance capitalism, and if they hold their iPhone or their Google mobile services device and it's calling a server 100,000 times an hour reporting back who you are, where you go, who you call, what you buy, and what you browse, your data is is leaving you at the rate of a machine gun every minute, every second, every hour. So that ship has sailed as well. There are other options for that, but that's for another day to talk about.
All right, Erik. Well, we're going to leave it there. Hope we get that other day to talk to you. Thank you for joining us. Erik Prince, non-executive chairman of Swarmer and the founder of Blackwater. Let's get a check on the markets this morning. Over an hour into your trading day, we are looking at equity still pushing higher. Not much movement, up 0.6%. NASDAQ outperforming, up 0.8, aided by a 10-year yield, which has been dropping. We're down 2 basis points at 419.65. A Fed decision tomorrow with probably not much happening, but Brent crude still moving higher by 1% as oil energy infrastructure continues to come under attack in Iran. Brent crude trading at $101 a barrel and 14 cents. Matt.
All right, coming up, Nvidia's CEO makes a $1 trillion AI pitch to investors. Venture capitalist Songyee Yoon weighs in next. This is Bloomberg Open Interest.
I'm here to tell you that right now where I stand, a few short months after GTC DC, 1 year after last GTC, right here where I stand, I see through 2027 at least $1 trillion.
Nvidia CEO Jen-Hsun Huang pitching a $1 trillion AI future. Joining us now is Songyee Yoon, founder and managing partner of Principal Venture Partners, an early-stage venture firm focused on AI-native companies. Songyee, wonderful to see you in person. Thank you so much for joining.
No, thank you.
And just looking through some of your portfolio companies, you have a lot that kind of exist in the infrastructure realm, like Together AI, an open AI cloud platform, Lambda, GPU cloud infrastructure, AI developers. Is that really where you're concentrating your efforts? Do you want to be in the picks and shovels type stack of the AI universe?
Yes, absolutely. I think we all believe in this kind of AI, introduction of AI is a kind of latest platform shift that we're experiencing. And I think the building out infrastructure, there is a real demand, and I think there is a lot of interesting business that's going to be built around that theme. So we do invest in like picks and shovel type infrastructure companies in this AI.
So are you not concerned that a lot of investment, and I'm not speaking about your portfolio specifically, is too much considering either the return on investment that we'll see after or how long that's going to take to play out? Because in 2000, we had a similar situation where everybody was laying fiber, right? And it turned out to be an investment that didn't pay off for many, many years.
That's a very good point. I think it's not just introduction of internet, but like a railroad electrification. All those kind of platform shift came with kind of the overcapacity build out, and I think there is a lot of investments that would not see that required investment return. But having said that, I think there still is, it is a true demand. There is a need for this new infrastructure and then applications that will be built on top of it. So my job is invest selectively in companies that's going to sustain and the generational winners in this turbulent landscape.
When you look out at the VC community as a whole, I speak to Orlando Bravo of Thoma Bravo a lot, and he's been saying for some time that VC is just like throwing everything at the wall and just seeing whatever they can make work out of AI, that there's this new frenzy about it, and that a lot of the things aren't going to come to fruition, that returns aren't going to necessarily look great. When you look out among your peers, is it a frenzy? Is that a fair characteristic of what's happening?
I mean, if you throw money at wall and see what sticks, yes, that's what's gonna happen. But that's why we do a lot of the kind of due diligence and trying to understand how the kind of the landscape pans out. So we invest in companies that are building durable infrastructure that's going to be indispensable in the coming AI decades. And also we also invest in consolidated vertical kind of play companies that are building defensible data flywheel moat. So that's going to be stronger and more indispensable to our daily lives going forward.
So software, what's your take on AI eating software's lunch?
I think that's a really great point. I think that kind of grabbed everyone's attention over the last couple of weeks. And I think it is true that like some of the SaaS models, when they're built upon the premise of like you pay some subscription per seat, per head count, while although some of the seats are replaced by like agents and other software, I think it could look terrifying to some of the investors. But I think we have to be very selective. Some of the companies will get even more stronger with the help of AI, whereas some of the companies will get replaced with this AI, a new type of AI and agent software.
You do a lot of work around this idea of responsible and ethical AI. You have your own philanthropy. You serve on the advisory council for Stanford's Institute for Human-Centered AI. Are you feeling optimistic that that's how things are evolving? I mean, we were just talking about Anthropic, and they're dealing with the U.S. government saying, you know, we want to have guardrails, and the U.S. government goes, fine, we'll just turn to OpenAI. Is this evolving faster than we can regulate it and make sure it retains that human-centric type technology?
I mean, that's a great question. And I think as a VC, I have an optimistic view of the future. Optimistic view of the future not only includes in kind of belief in the technology, what it can do for humanity, but like overall, like human flourishing and enhancing the human ability and kind of unlocking our human potential. And to do all of that, I think it's important to think about what is the public-private collaboration here that's needed. And I think it's setting the right guardrail so that there is nobody really kind of falling through the crack, and help those who need the upskilling will be provided with kind of opportunity to be educated. And I think that's a kind of role of the kind of public infrastructure and the government. And when we believe in human potential and kind of humanity progressing, we should believe that that's going to happen, and that's going to be necessary, indispensable part of our future.
Songyee, as somebody who has such a great inside look at all of this technology and such a broad understanding of AI and privacy concerns, how do you lead your daily life? Do you ever accept all cookies? When you browse, is it incognito? Do you use a VPN?
I reject all. No, I mean, I think it really depends, and I mean, I think that's one of the concerns, and I think I try different type of like cybersecurity software that help me to have the kind of visibility and also kind of type of traffic that I get. And also the kind of phishing attempt and all of those things. I think there is a way to have more transparency, kind of look into those kind of traffic and be prepared. But I think it's to some people it could feel like a landmine, and there's a lot of things that can trap.
Well, there's that side to it too, and I realize these are very existential and big picture questions. But then there's this other idea of technology not only just replacing things like software, but replacing white-collar jobs, and that VC is investing in companies that theoretically could go as far to do that. Do you think that it is a real reality that a lot of jobs are going to be replaced by AI in the future?
I mean, yes and no. I think a lot of the jobs we see today didn't exist 10 years ago, like YouTubers and like podcasters. We didn't even think about that's going to be a job in like 10 years from that time. I think that similar thing will happen. I think some of the kind of workflow that feels quite manual will be automated and it will take a lot less people, but there will be other type of jobs and other type of work that will be available because of the kind of availability of the software.
All right, Songyee, great having you on. Love having your view on this stuff. Songyee Yoon there is founder and managing partner of Principal Venture Partners. Coming up tomorrow, Sinead Colton-Grant of BNY Wealth, David Miracle of Goldman Sachs, and Health Equity CEO Scott Cutler. This is Bloomberg.